I'll be talking to everyone today about investing in Canadian real estate, and particularly with a focus in BC because it's kind of a hot commodity around here. People like buying houses for whatever reason in Vancouver. I mean, it's a great city, so there you go. So the way I want to structure this is sort of a cradle to grave scenario. So we'll start off with what are the tax implications of purchasing real estate? What are some of the tax implications of that ongoing use of the real estate? And what do you have to think about when you're ultimately selling your real property? It's a lot of topics. This will be a really broad overview. There's a lot of technical minutia that is involved with real estate, so it's important to keep in mind that there's a lot more that's going on behind the scenes that we just don't have time to talk about in great detail. So let's jump right in. So purchasing real estate. Question is, do I need to pay GST on the purchase of this real property? Technically, all real estate initially is subject to GST, HST on its purchase unless it falls under certain exemptions. And understanding the exemptions, you have to know the definitions of what's considered residential or commercial property. So commonly you might know that used residential buildings are exempt from GST, HST. Now, new residential buildings are subject to GST, HST, but you may be eligible to get a GST rebate from it in certain circumstances. Now, commercial property, on the other hand, will always be subject to GST, HST, but a couple interesting points on this. The definition of commercial property isn't really related to the zoning of the property, but can relate to what that building is used for. So if you're operating a bed and breakfast operation and you're purchasing that, then that can be subject to GST, HST. There's also no difference that's paid to whether that commercial property is used or new. Another interesting bit is if you have vacant land. So let's say that you purchase a piece of vacant land and you want to go and build a residential property on it, but you never get around to it, the cash escapes you, whatever. If you sell that property, then that's also subject to GST, HST. So it's important to keep in mind whenever you're involved in these transactions, at least in the back of your head. If you're, again, this is in the context of you approaching this as a purchaser, and specifically with respect to commercial real property, you want to make sure that as the purchaser, that you're a GST, HST registrant. Typically, the purchaser is the one that's solely responsible for reporting the GST implications on a self-assessment basis. And assuming that you as the purchaser are qualified to claim input tax credits on the entirety of what you pay for the GST side of it, it should net out to zero. So if you buy a $1 million piece of property, your GST component would be $50,000. Assuming that all of your business is producing taxable supplies, that is that you have to charge GST to your customers, it should come out to a net zero basis. Now the problems can happen, and you definitely see it happen in practice, is when somebody forgets to register the purchaser corporation for GST, HST. In those kind of situations, the vendor is still responsible for the collection of GST. So you can end up with this big timing mismatch where you as the purchaser now need to fork over the extra 5%. Maybe your financial institution isn't willing to go and finance that portion, so you need to come up with it separately. And when you're wanting to go and claim the input tax credit, maybe you're an annual filer. So it could be 11, 12, 13 months down the road after you pay that GST before you're able to go and claim the credit, and after you've had to go and pay that amount to the vendor. So very, very important to keep in mind. As the vendor, just on the opposite side, it's important to ensure that the purchaser is registered for GST so that you are not caught on the hook for the forgetfulness that might be involved. Property transfer tax. Generally, this is triggered by a change of name on the title to the property. It's something that's provincially regulated, varies by province. Some provinces don't have a property transfer tax. Some are better than BC's, some are worse. It really varies. But since we're in BC, I'll just talk very briefly about them. So on that first portion, you're looking at about $2,000 of property transfer tax. If you fall in that second bracket of 2%, that's another $36,000 on top for a $2 million property for a total of 38, and then the sky's the limit for that last 3%. So it can definitely add up very quickly, and there are incentives for workarounds. So what you might often see are businesses where you have like a large corporate group, and one of the things that they have is this piece of land. They might incorporate a bare trustee corporation that holds the title to that property, and if they need to move that land around from one company to another for this reason or that, they won't be subject to the property transfer tax on that internal reorganization. So very helpful, definitely saves a lot of money to go and do it that way for a fairly minimal ongoing cost for that corporation to exist. The additional property transfer tax, or as you might know it as the foreign buyers tax, is very, very popular. So this was a measure introduced to curtail the investment by foreigners into real estate in the Greater Vancouver Regional District. It's 15% of the purchase price of the property. And as you can see by the word additional, it is on top of that 1, 2, 3% that was mentioned in the earlier slide. So it can really get up there very, very quickly. Similarly to the GST issue, you might have a question as to whether this amount is financeable by your financial institution, as there is no underlying value to that property transfer tax. It's just on top of whatever the value is. So this applies to individuals, corporations, trusts, and there's really not a whole lot of ways around the legislation. I remember when this first came out, there were a couple people who were like, "What's the way around? What's the loophole?" There really aren't a whole lot that you can do. If you're caught, it's quite tight. Now, before you get too excited that I haven't mentioned partnerships or joint ventures, instead of the whole property being considered eligible or subject to rather the foreign buyers tax, you're instead subject to the proportionate share of your interest in that partnership or joint venture. So let's say that you have a 30% interest in one of those entities, and let's say even that the remaining 70% is Canadian resident owned. Then that 30% portion times 50% or 15% of its value will be subject to this foreign buyers tax. So that was all I wanted to really talk about for the purchase. So on the ongoing use, GST on the rental of real property. Again, on a general basis, it is the rental of real property is subject to GST, HST. Again, you might be very familiar that the exemption, or that there is an exemption that applies for the rental of residential real estate for long-term tenants. That's very important, especially with the prevalence of Airbnb, as you'll see that recur throughout my presentation, that there's a strong distinction that's made between long-term and short-term residential rentals, and that important date is 30 days. So if you have long-term residential tenants, then you don't have to charge GST. But if they're short-term, so if they're there for only 2 days, 3 days, 5 days, you have to charge them GST, subject to small supplier rules and so on. It's definitely a big risk area for Airbnb properties, as people who own and operate those things, they make money hand over fist. So they're going above that $30,000 threshold in no time, and you ask, well, did you collect any GST? Like, GST, why do we need to collect that? It's a residential property. I've never had to pay GST when I've rented from one. You do. So on the other side of that, commercial real property, there are no similar exemptions. If you're renting out that commercial real property, you have to charge GST pretty much full stop. So change of use rules. So you can either use a piece of property for an income earning purpose or not for an income earning purpose. And when you go from one to the other or back, that's what's considered a change of use for income tax purposes. And what happens is that you are deemed to have sold that property at the time when you have changed its use equal to its fair market value. So often what you'll find in Vancouver is that you have a capital gain that results from that you need to deal with somehow. So are you going to include that in income? Are you going to get an exemption through the principal residence exemption? What can you do? Well, one of the things you can do is kick the can down the road and defer the tax with one of these elections. So the 45(2) and 3, basically what it is one applies when you're going from a personal use property to an income earning, and the other one is in reverse. And these elections do two things. One of them is that they deem that deemed sale didn't happen, so it's just saying, okay, we're fine, nothing's happened, you don't have any immediate tax consequence. So that can be good in a number of circumstances. But the other thing that it lets you do is it lets you use plus or minus, for the one where it's changing from personal use to income, it lets you look 4 years into the future to go and claim each of those years as a principal residence, even if you have not lived in the property. So it can be very useful especially if that's the only property that you own and you move to a rental or back and forth, to be able to get a little bit extra of tax-free room on the eventual sale of that property. It's an important thing to note is that it's not always beneficial to defer this disposition. There are a number of examples, and I won't bore you with the details, but it's important from an issue identification standpoint that you recognize that it's not always beneficial to do it when there are multiple properties involved, especially if you're in the year of purchase or sale. It's not always beneficial if you're immigrating from Canada, as you might want to cut it off while you're a resident of Canada, which is one of the qualifications for having the principal residence exemption. And the other one is a little bit of a crystal ball for significant changes in value. If you foresee that income earning property is going to skyrocket in value, maybe it's better to trigger the tax consequences now, and if you move into that property, that you can shelter that entire portion as a principal residence exemption instead. So a little bit about non-residents. So if you're a non-resident landlord, there's a requirement to remit 25% of your gross rents to CRA. And if you have an agent working in between, you can choose to file this NR6 form that instead of having to do it based on the gross rents, you do it based on the net rental income for that property. So you're able to work in the expenses so that you don't need to remit as much to the CRA, and more of the cash stays in your hands on an active basis. Now, ultimately, if you're planning on filing a Section 216 return, which is the rental income tax return for non-residents, this difference is settled at the time when you file your tax return. So if you don't really care, or you don't have an agent, or you don't really mind, or you'd rather have it be simple, then you can wait until you have your personal or your corporate tax return filed. Most of the time, one thing to note is that you don't need to file one of these 216 returns if you're happy with the 25% gross withholding tax. But usually when people are renting property, they have a bunch of expenses, strata fees, property taxes, mortgage interest, and so on. And you can definitely reduce your tax liability by just filing one of these returns. So typically not a better result to just ignore the tax liability there. I also wanted to touch on the vacancy tax. So this is a Vancouver only bylaw. And the way that this tax is assessed is at 1% of the assessed value of the property if that property is considered to be vacant. Now, this is a brand new tax. It's going to be effective for the 2017 year and onward. And the way I understand is they'll be sending something in the mail in November, December, and you have until February 2nd to respond to this to say, yes, my property is vacant, or no, my property is not vacant. So if you say that your property is vacant, you get hit with the 1% tax. If you say it's not vacant, you don't get hit with the 1% tax. Now, if you don't respond to that letter, then the property is deemed by the city to be vacant, and you'll be assessed that 1% tax regardless of whether it is or is not vacant. So a very good idea to respond to that document and not let it sit on your kitchen counter. The other thing to mention that I wanted to mention on this is that the city has put almost comically large penalties if you're caught with a false declaration of this. And one of the ways that they plan on enforcing this is through a tattletale system. So hopefully you're good friends with your neighbors if you're planning on having a vacant home. Maybe bake them some cookies or something if you want to mend fences. Because if they tattletale on you and something is triggered by the city to look into it, then there is exposure to some very substantial penalties. Now, the way that the legislation is worded is that there's a lot of double negatives. So allow me to kind of rephrase the way that it's termed to say, instead of where you're subject to the tax, how you can be exempt from it. So you're exempt from it if the property is your principal residence of the occupier, or if the property is occupied by a tenant or subtenant for a term of at least 30 consecutive days over a total 180 days in the year. So one interesting point for each of those. One is that the principal residence there, it's not the same thing as for income tax. It is a completely different definition, and frankly, it's really weird. It has stuff like, where do you open your mail? Where do you pay your bills? Where's the address listed on your driver's license or your MSP or your income tax? So clearly you can have a situation where your principal a property that qualifies as a principal residence, like a vacation home, for income tax purposes, might not qualify for this vacancy tax on the basis that you primarily do these activities elsewhere. The other one on my Airbnb tirade here is that it's very unlikely that your Airbnb will qualify for this vacancy tax. Or for the exemption from the vacancy tax, because the principle is that you have a single tenant that is staying there for more than 30 days. So if your Airbnb is operating on 190 days straight, it's rented. It's a super popular Airbnb site, but they're all in 2-day, 3-day, 4-day chunks. You have to submit that response to Vancouver as it being vacant. Because it's not consecutive days by the same person. So it's very likely that something like that could fall offside. So finally, to the sale of real estate. So just to show a little decision tree of what you do when you have a gain on a sale of property, it's either going to be exempt or it's going to be taxable. The exempt is more or less the principal residence exemption, and the taxable is everything else. So the taxable component, it gets split into two. It can be one of two things. One on account of capital, the other on account of income. Capital gains tax preferentially 50%, income, the ones that are on account of income, 100%. So there's a clear benefit to having these properties treated as capital gains instead of income, but it's not always possible. So just to briefly discuss on what the difference is you have to ask yourself, what was the intention of the use of the property when you purchased it, and did the intention somehow change after you had purchased it? A couple extreme examples just to highlight when it would be considered business income is if you're a real estate developer. So if you have your farm of 40 properties that you're selling off lot by lot, the only reason that you're developing those properties is to sell them. It's not so that you can live in it. It's not so that you're going to earn rental income from it. It's so that they're gone. So that's clearly a case of it being business income. The other one is flipping houses, like those reality TV shows where they gut the house and they turn it around and make a whole bunch of money. The whole purpose of you buying that property was so that you could gut it, fix it up, and resell it. So that is also going to be subject to business income rates. Now, the interesting thing is that there are sometimes circumstances outside of the property-specific qualities that could influence CRA's perspective of whether this taxable sale is on account of capital or on account of income, namely your profession. So keeping that in mind, if you're selling that personal property, is there a good reason to having sold that property in a very short window of time? So as an anecdotal item, I had a client this last year who sold 2 properties, and both of them were in fact lived in by that person. So the first one he had sold because he was just starting a young family and there wasn't enough space in that first property, so fair enough, we bought this new one. Once he got there, the kid was born. This place it's still not large enough, and they wanted to go and expand. And of course, with Vancouver real estate market, it appreciated like $150,000 to $200,000 in that few months span. So he sold it again, and he was able to claim the principal residence exemption on both. Now, the tricky thing with all of this is that he's involved in the sale of real estate. So from CRA's perspective, does that developer have a higher does that developer have some sort of higher onus to prove that this is a capital sale rather than something that he's doing on the side outside of his corporation in order to ensure that gets capital gain treatment or qualification for the principal residence exemption? So does GST HST apply to the sale? I just refer you to my previous slides. Again, you want to make sure that the purchaser is ultimately registered. And everybody's favorite topic, principal residence exemption. So just as a thing to open it up with, CRA has been reviewing principal residence exemption claims. It's a very good idea to have your documentation in line. So that's your original purchase statement of adjustments, your sale statement of adjustments. If you've made substantial improvements to the property, you've built a new wing, you have a new garage, whatever. Keep all of those invoices because that supports your ultimate cost base. Now, the qualifications for the principal residence exemption are these 3 listed here. So this property needs to be ordinarily inhabited by the taxpayer, their spouse, or minor children. The taxpayer has to be a Canadian resident for tax purposes in that year that they're assigning the principal residence exemption to a particular property. And the spouse or common law partner has not designated a different property for the same tax year. So just briefly on ordinarily inhabited, that doesn't mean that you live in it all the time. A vacation home is fine if you're using that on let's say for summer vacations every year, you go to Hawaii and you have that. So foreign properties, those are okay too, from a Canadian tax perspective, not necessarily the local tax perspective. And the other thing is with trusts. If you have a principal residence that's within a trust, it is possible to claim the principal residence exemption. There are a few extra forms that need to be filed and some questions as far as whose principal residence exemption is being used for this, but it is possible. The other thing of note is that since this last tax year, you're required to have disclosed on your personal tax return the sale of these principal residences, even if that sale is 100% covered by the principal residence exemption. So make sure that if you haven't done that, that you maybe fix that up and that you report it accordingly going forward. Obviously it's not available for any corporations. It's strictly for individuals or trusts, and it's not available on property held for business income. So the question is, if you have multiple personal properties, what do you assign the principal residence exemption to? Is you can only pick one property per year. So from a strictly financial point of view, you want to look at the capital gain per year test. If you have a property with $100,000 latent capital gain and you've owned it for 10 years, and you have another property also with $100,000 capital gain, but you've owned it only for 5, your principal residence exemption is best served to go on that property with the $20,000 per year instead of the $10,000, as then you can use the other 5 years on that other property and come out a little bit ahead. With that said, it's not the only thing to consider. If you have short or long-term, or really it's more the short-term cash needs, using my previous example, if you're keeping that property with the $20,000 per year capital gain, and you're selling the property with the $10,000 one, do you want to use all of your principal residence to defer the tax on these properties in general, or do you want to do it from the optimal financial point of view? And your short-term cash needs can definitely play into that. Don't forget about the plus 1 year rule. There are also the recent change where if you are a non-resident when you purchase the property, you move to Canada, now you no longer get the benefit of that plus 1 year rule to help you get a little bit ahead or to exempt the sale. And as I mentioned earlier, any residents outside of Canada also can qualify for the PRE. So the last thing I wanted to talk about is if you're a non-resident and you sell real property, there's a lot of different things that happen here, very similar to how the rental income side works. So you have 2 options. One of them is that that 25% of the gross proceeds of the sale need to be withheld and sent to CRA, or you can file what's called a clearance certificate or certificate of compliance, and you're able to use that cost base, the amount that you've paid for the property and its big permanent structural changes against that, so that you're able to facilitate cash flow a little bit better. There are some very limited circumstances where it's 50%, but most of the time you're looking at 25% withholding. The options to go and do this are purely for accessibility to cash. When you file your tax return, which you're compelled to do as you've disposed of real property in Canada, you're going to get into the same position regardless of whether you file this. But especially in the Vancouver real estate market, it can be a really significant amount of money that if you get access to it a few months better, you can redeploy it to earn yourself something more elsewhere. So it can often be a benefit to apply for these clearance certificates. You want to, the thing that I want to stress here is that those clearance certificate requests, it's sort of like a pre-audit for CRA. So they want to see the original documentation that relates to your purchase, any of those additions. They want to see the proposed or completed sale documentation in order to approve the reduction of this withholding tax. After you get the clearance certificate, you need to file your personal corporate tax return along with the original of one of those copies, and sometimes principal residence exemption designation if you are resident in Canada for some period of time. Now, these clearance certificate requests can take a long time, so a way to expedite it is to get a comfort letter, and that can be applied for in tandem with the clearance certificate. And there's usually a much faster turnaround to go and get that to happen, so you can get the access to your cash that much faster. So in conclusion, there's many facets to taxation of real estate in Canada. Again, this was a real bird's eye view of everything. There's a lot of nuances involved, and I mean that's what we're here for, to know about all those things. So if you get involved with the purchase of a piece of real estate or its sale, it's really best to contact your favorite D&Co advisor, and then we can help you figure out what all the consequences are. And with that, I'll pass it off to Les.